Paul Dietrich is Chief Investment Officer at B. Riley Wealth Management, joining us live with his thoughts on the markets. Paul, good to have you on the show. Thank you very much for your time. I do want to get your thoughts in on what's transpired across the pond in Europe and the ripple effects of the same.
Well, I actually think that central banks are coming in and they're going to support all these banks just as the U.S. is supporting depositors in the United States. I think the real story here is the reason that the banking sector in general is going down, not just for specific banks, is because of the worry that investors have of banking earnings going forward. With the inverted yield curves that are not only in the United States but all over the world, banks make money by borrowing short-term money and at whatever rate it is, and lending out long-term for mortgages, 30 years, and for business loans. And in an inverted yield curve where it costs more for short-term money than long-term money, you can't make money as a bank. And this is the main concern that a lot of investors have. The second concern is, as a result of that, there is now an ongoing credit contraction. Certainly we see it in the United States. I assume people are seeing it all over the world. Lending standards are getting higher. And especially regional banks here in the United States, as they contract their lending, that's mainly to small businesses in the United States, and it's going to really slow the economy, and that takes you eventually into a recession when the economy slows enough.
Where do you hide at a time like this, Paul? Energy, gold, U.S. Treasuries, I don't know how much. It's maybe the short duration, but the way it's come off is dramatic. Or even for that matter, the dollar index.
Yeah, that's exactly right. I know an awful lot of people who are moving money out of banks and money elsewhere into short-term treasuries. They're putting it in gold. We saw oil and energy prices really go down recently. But I think once China gets going again, I think energy prices, because of sanctions on Russia, for all sorts of reasons, in the long term, that's something that's probably going to go up, even though you can't see it right now.
Among the banks, I was just having this conversation with Sonia, who left me with a thought about there being value at such dirt cheap levels. So yeah, obviously Credit Suisse is cheap, is very cheap for a reason. But at some point in time, if obviously you have a backstop, you have an extended credit line offered, then some of these beleaguered banks may offer value, because every asset has a price. You just have to determine it on a discounted cash flow basis. So what's your sense? Do you think that there could be opportunity in some of the regional banks in the U.S. and in Europe? Because yesterday some of the Italian banks also went down quite heavily.
Yeah, I think that the regional banks, a lot of the good ones went down with the bad, and there are probably some short-term trading opportunities. But the problem is that we do not know what the earnings are going to be in the future if there's a huge credit contraction, which seems to be starting to already take place in the United States. And so, do you use the price-earnings ratio now? Do you use their forecast price-earnings ratio? Nobody knows. But almost everyone who's thinking about this deeply knows that there's going to be a severe earnings recession in banking so long as we continue to have an inverted yield curve. And I think that's going to keep the entire sector down for quite a long time.
Does that mean the Fed would announce next week to stop QT and also support the inversion of the yield curve to flatten it out a bit?
I definitely don't think the Federal Reserve is going to do that, because what's happening in the banking sector is not necessarily related to inflation. In fact, if the banks contract credit and slow the economy, they're doing the job that the Federal Reserve is trying to do right now, which is to slow the U.S. economy. And so, I think they're quite happy with this, because this is going to, if anything, help bring down inflation in the long term if we contract credit. And we're already seeing today retail sales are slowing. So there is some impact, but having all the banks lending less, and they're doing that partially for their own reasons, because they're not going to make money in an inverted yield curve environment. And so this is, I think the Federal Reserve is going to raise rates by quarter percentage points. I do not think they're going to stop quantitative tightening, because this is exactly part of their game plan, which is to slow the U.S. economy. And all of this is going to help them.
Definitely help them, but I don't know whether they'll be happy about it, Paul. I think the Fed is stuck between a rock and a hard
place. The banks are not happy with it.
Yeah,
the banks are not happy with it, but I think the Federal Reserve, no, I don't think anybody in the U.S.
They have to maintain financial stability. At some point in time, it has to be a balance between price stability and financial stability. I don't know how they strike that balance at this stage, but yeah, you have a point there. So it's going to be a tricky one. It's a good, sorry.
Yeah, they've already struck that balance in that I think everyone's comfortable that by the Federal Reserve with this new credit facility, that they're guaranteeing depositors that they're not going to lose any money. I don't really think people are worried about their particular bank not being able to access their money. That's been solved. And so they have that stability in the market. Investors are worried about banks in general and their profits, and that's part of the decline.
You make a good point. You make an interesting point. I would still not choose the word happy to define the Fed's position, but you make an important point, Paul. Thank you very much. We'll see what happens next week with the Fed's decision and policy meet.